Good morning, ladies and gentlemen, and thank you for standing by. Welcome to Regional's fourth quarter 2025 earnings conference call. We are joined today by Manuel Rivero Zambrano, Chief Executive Officer of Regional, Enrique Navarro Ramirez, Chief Financial Officer, and Alejandro Loera, Head of Strategy and Planning and Investor Relations. At this moment, all participants are in listen-only mode. After the speaker presentation, there will be a questions and answer session. To ask a question during the session, you will need to press Raise Hand button. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your speaker today, Manuel Rivero Zambrano. Thank you, and please go ahead.
Good morning, everyone. I hope you and your families are doing well. Today, we are presenting our fourth quarter results, which reflect disciplined execution and continued focus on operating performance. We're operating in uncertain environments as Mexico GDP's growth has slowed and there remains uncertainty around trade policies. Our commercial strategy continues to prioritize expanding our presence in key regions while maintaining strict cost control and disciplined credit underwriting. We also remain focused on diversifying our income streams, particularly through non-financial revenue growth, as well as increasing cross-selling, which helps partially offset lower demand. Net income for the quarter reached 1,814 million pesos, representing a 7% year-on-year increase. Return on average equity decreased by 224 basis points year-on-year, reaching 19.1%. While this is lower than our prior periods, it remains at healthy levels and reflects our continued prioritization of asset quality and profitability. Our consolidated NPL ratio remained at 1.3 and 1 basis point year-on-year, and our cost of risk declined by 3 basis points to 1%. Overall, we are pleased with portfolio health and have not observed any significant deterioration in credit quality. We remain disciplined in underwriting and risk management. Regional delivered solid year-on-year loan growth of 8%, supported by sustained commercial activity, particularly in high-performing regions such as Jalisco and segments like SMEs and auto loans. On the funding side, core deposits grew 13% year-on-year, highlighted by continued client trust and engagement. Growth in both loans and deposits contributed by a 7% expansion in the financial margin, supported by higher volumes and disciplined pricing. Our diversified efforts continue to gain traction, while card merchant fees up 17% year-on-year and insurance fees 25% quarter-on-quarter. Non-financial income increased 10% quarter-on-quarter, providing some offset to the margin pressure we anticipate in future periods. Operating expenses increased 17% year-on-year, driven by technology expenses, strategic investments in geographic expansion, and inflationary pressures on operating costs. As a result, the efficiency ratio rose to 40.2%, an increase of 258 basis points year-on-year. The wholesale loan portfolio grew 7% year-on-year, while the notable strength in Jalisco, where growth reached 21%. We continue seeing the same environment, although the increase of policy could start motivating more demand. Wholesale banking demand deposits increased 42% year-on-year, bringing our CASA ratio to 45.7%. Retail banking continued to show healthy momentum, with preferred banking demand deposits growing 9%, reflecting solid client engagement and trust. Our branch network continues to expand its disciplined manner, focused on higher potential locations that align with evolving customer needs. Notably, auto and consumer loans grew 13% and 10% respectively, an indicator of growing client acquisitions and deepening relationships. Asset quality remains in key strength, with non-performing loans ratios at healthy levels across all segments. The wholesale portfolio reported an NPL ratio of 1%, consumer portfolio 3.2%, auto an outstanding of 0.6%, and mortgages 1.2%. These metrics reflect the effectiveness of our underwriting standards as a resilience of our customer base. While we remain vigilant amid shifting and macroeconomic environment, we believe we are well-positioned to navigate potential challenges through proactive risk management and a diversified portfolio. Hey Banco continues to advance in strategic shift forward, profitability over pure growth, prioritizing high-quality customers over volume expansion. This disciplined approach is delivering results. Individual demand deposits grew 20% year-on-year, while our business loans portfolio grew an impressive 33%, demonstrating strong traction and targeted segments. Hey Banco reported a financial margin of 297 287 million pesos, and net interest margin reached 10%, an increase of 302 basis points year-on-year, reflecting improved asset yields and a more profitable customer mix. Our efficiency ratio improved to 57.6, a 1,403 basis points year-on-year reduction, highlighting progress in the cost containment, even as we continue investing in automation and digital capabilities to mitigate structural cost pressures. Our active individual consumer base now stands at 476,000, consistent with our strategy of prioritizing quality over scale. We reduced our cost of risk by 166 basis points to 5.47, while remaining vigilant on credit trends in the current environment. We are happy to announce that the spin-off process of Hey Banco will be completed this weekend. Profitability continues to improve. As Hey Banco, we are encouraged by the ongoing upward trend. Net income for the quarter reached 55 million pesos, and given the progress we made in customer mix, pricing discipline, and cost containment, we expect profitability to continue trending higher going forward. Turning on Hey Pago, we continue to see positive performance across our payment businesses. Total bill increased 34% year-on-year. Growth during the quarter was primarily driven by the payments facilitator segment, which increased 150% year-on-year, reflecting a broader adoption of the acquiring and processing solutions among partner merchants. At the same time, we continue to see stable contributions from aggregators and large corporate clients, supporting diversification of volumes. Looking ahead, we expect payment business to remain an important contributor to growth, while maintaining a disciplined focus on scalability, operating efficiency, and profitability. Our results this quarter reinforce the strength of our core operations and the consistency of our strategic priorities, while continuing to generate sustainable growth even amid a more challenging environment. This momentum we've seen across our key business lines, together with our prudent risk management and ongoing cost discipline, give us a high degree of visibility and confidence in meeting targets we set to 2026. While this solid foundation and ongoing momentum, we anticipate delivering top-tier results again in 2026, guided by our targets of total loan growth between 5%-10%, total deposits growth between 5%-10%, net interest margin between 6% and 6.3%, efficiency ratio around 42%, net income growth between 5%-10%, return on equity between 8% and 19%, cost of risk between 0.8% and 1%, NPL ratio below 1.8%, loan growth between 15% Hey Banco's guidance, loan growth between 15%-20%, and net income growth between 65%-90%. Moving forward, we will continue to enhance our operations and explore new opportunities, fully committed to our strategic goals. We are confident that Regional will remain a strong financial performance in the coming years, ensuring superior profitability and asset quality than the system. Thank you very much. We appreciate any questions.
Please stand by while we compile our Q&A roster. Our first question comes from Eric Ito from Bradesco BBI.
Hi, Manuel, Enrique, Alejandro. Thanks for the opportunity of asking questions. I have two here on my side. The first one is on your guidance on NPLs. You're guiding for 1.8%, but you ended the year with 1.2%, 1.3%. So I just want to understand if you expect major deterioration throughout the year. And then my second question, which is also linked to this one, is regarding the potential regulatory changes. So if we look at your write-offs, it went up from around 400 million in the third quarter to almost 800 million in this quarter. So just want to understand what should we think about the recurring level for this write-offs going forward in 2026? And then the last one, if you could comment on your updated estimated impact from the potential changes from the interchanges, would be good. Thank you so much.
Okay. Thank you.
In terms of NPLs, our guidance, as you can see on the screen, we usually guide below 1.8. We expect some deterioration, normal or regular, around 1.5, but we wanted to have room for specific cases. That is what was happening for the whole year. At the end of the year, and I will move to the second one. At the end of the year, we managed to reduce the NPL to 1.3, 1.28, based mainly on the recovery of, the foreclosure of one of these large customers. We foreclosed many flats from a building, and then in the other one, we managed to restructure, and they paid at least 3 payments during the year. That's the main part that is on the move from NPL to regular ones. And as you mentioned, we brought off, usually we do at the end of the year, we evaluate all the loans that has been past due, and with the new methodology of provisions, also we validate the possibility of recovery, because we have most of them are on the legal process, and we decided to write off all the ones where we don't see possibilities of recovering. That is around 300 million pesos that you can see on the quarterly report. That explains the increase. We don't guide, or we don't have an expected regular amount of write-offs. Mainly we can project in consumer or mortgage or small businesses, but in large or what we call empresarial, we don't forecast write-offs. We don't see a large amount in the next 2 or 3 quarters similar to the ones on the fourth quarter, but just regular day-to-day. And in consumer, we write off regularly once they reach 180 days, 6 months past due. In the small businesses, basically after 1 year and a half, 18 months. But in large business, is really when we have the certainty that there is no possible recovery. Then we don't see the main impact that we see in terms of regulatory changes is not in write-offs, even though the regulation change and it will take longer to do the deductibility in taxes. The process is similar, and for this year, the rule is that after 2 years of starting the legal procedure or demanding the customer, suing the customer legally, we can write off. Usually we take longer, then it won't affect. In the large customers, we take longer than that period. The other one that is already reflected on the net income growth is the non-deductibility of the 75% of the IPAB or the IPAB. As you know, the government say that is more a tax than an expense. Then we cannot deduct the 100%, only the 25%. You will see that our tax effective rate will be increased in the next quarters due to that change. Is the only real material one. The other ones will not have a lot of impact, at least for us.
Okay, thank you. And could you...
In terms of the interchange, is still on consultation. The request for information from the government to the many different entities that we participate on the payment market is finished the next Friday, the 31st, officially 31st, the Saturday, but the next Friday, they are open to receive feedback, and then they will decide if they applied the change to the interchange fee. But right now, we are not considering any change in our budget. We are considering the same level of fees, both on debit cards as well as in credit cards. As we will wait, and we're expecting that process to finish during the next 2 quarters.
Okay, perfect. And then just a follow-up, if I may, just on your effective tax rate, you mentioned that you expect to increase in the next quarter due to the IPAP change. Could you give us some color here on the expectations of the levels that could go up?
Yes, it has been between 25-26 for the last quarters, and we expect it to move to 27-28 for the next quarters.
Okay, very clear. Thank you. Thank you so much for your help.
Our next question comes from Ricardo Buchpiguel from BTG Pactual.
Hi, everyone, and thank you for the opportunity of making questions. I have 2 here on my side. So first, it'll be interesting if you could provide more details on what should be the main segments and regions driving loan growth this year. And also comment if you do believe any new resolution or agreement in the USMCA deal is necessary to reach this 5-10% loan growth, or eventually a resolution on this topic would be like a potential upside risk to our loan growth numbers. And for my second question, Regional finished the year with nearly 15% capital ratio. So if you could also remind us what is their target capital ratio and what should be our dividend policy for 2026, and also comment that if you eventually be a bit below, a bit above the target capital ratios because of eventually a potential weaker loan growth, if it makes sense to expect any additional payments that you usually pay compared to historical levels. Thank you.
In the first question, I will move to the second part first. No, our budget doesn't take into account an immediate solution or agreement, but it considers a better second half. That's where is implicit, but it's not. It will be more an upside risk than downside risk if there is not an agreement. We are expecting it for October, even though the dates that the government, especially the Secretary of Economy, he mentioned the July date that is on the agreement, on the USMCA agreement. Our improvement is only on the last quarter. Then for the most part of the year is not included any benefit or improvement from the USMCA agreement. It includes a small improvement due to the rate reduction. and it's in all the regions. It's more by segment than really for region. It's mainly on the small businesses, small and medium, not only small. And in terms of products, also auto lending is a segment where we have been growing around 20%, because it's growing both in Banregio as well as in Hey. And basically will be that the two main segments. Large customers will be in line with the guidance between 5 to 10 is the other two are above 10%. That will be in terms of capital ratio. Yes, and as Manuel mentioned, this weekend we will have the spin-off, the migration of the customers of Hey Banco to Hey Banco legal entity, or the new license, their own license operating fully, because right now it's operating just with the equity. Say that the capital ratio for Banco Regional will improve, and yes, we are planning to present to the General Assembly an dividend. We will follow the same strategy that we are following for the last 3 years. That is to pay the 25% payout after this General Assembly, the ordinary General Assembly that will take place someday in April. We have not yet defined a specific date. And then in October board meeting, we will again review the possibility. We see, as we mentioned in last quarter conference call, that there is a higher possibility to pay the fully 50% this year once the Hey migration is done.
No, that's clear. Just one quick follow-up. What would be the gain in capital ratios from the spin-off with Hey?
Because we will migrate the around 10 billion pesos loans from Banco Regional legal entity to the Hey Banco, but Hey Banco already have the equity. Then it will be reduced, the loans in Banco Regional, and it will be very low reduction on the equity. It will be not proportionally, because if you remember last year, we paid dividends to capitalize or to increase the capital of Hey Banco legal entity. Then basically the short answer is the 10 billion will be reduced on the loan book of Banco Regional without a further significant reduction of the equity.
Thank you.
Our next question comes from Ernesto Gabilondo from Bank of America Merrill Lynch.
Thank you. Hi, good morning, Manuel, Enrique, and Alex. Thanks for the opportunity to ask questions. The first one is, if you can provide a little bit more color on your NIM expectations. You guided between 6 to 6.3, and I remember you ended with around 6.3, so that will imply an NIM pressure of 30 basis points, no, in the low end. So what is the level of interest rates that you are assuming for 2026? And how are you picturing the lower rate to go throughout the year? If you think it will be throughout all the year, in the first half, it could give us a little bit color on what will be the evolution of the NIM. And then my second question is in terms of your operating expenses. I believe it was a little bit high than what we're expecting. It was around 14% for the full year in 2025, and I believe you were expecting more like a high single digit, low double digit. So just wanted to understand if you're anticipating some expenses for 2026, and how should we think about the OpEx growth in 2026? Thank you.
Yes. In terms of the policy rate reduction, we are expecting between 6 to 6.5, or say on the opposite, between 2 and 4 cuts along the year. Our budget is in the middle with 3 cuts, but the last one doesn't have a real impact. We expect 2 in the first semester and 1 in the second half of the year. That is about the rate expectancy for us. In terms of NIM, you are right. As the NIM is an average of 1 year, we will see the capture of the reduction after 1 full year of the reduction of the policy rate. Then we expect to continue reducing, not all the way of the 30 basis points, but some point in the middle. As we have been also mentioning in previous conference calls, part of instead of hedging or something like that, as you have suggested on other occasions, or question, not suggestion, sorry, question, if we are doing, we have increased our investment, our portfolio on CETES mainly, as a defensive way for at least 1 year. Our portfolio have increased to 53 billion pesos, and then that could help to reduce the impact immediately. But after 1 year, we will continue renewing the CETES portfolio, the investment securities portfolio. That is mainly CETES or bonds, are government bonds. In terms of operating expenses, yes, as we mentioned, is basically the same items. What we expect that is technology and the expansion plan for this year. Last year, we opened 10 new branches, and for this year, we expect around 15, mainly in the first half of the year. Then that's the part that will be not reducing cost, even though it's an investment, is reflected as an expense, mainly for rents and for people. But the effort that we did in the third quarter for cost reduction on people will be shown this quarter, the first quarter of 2026, and for the whole year. Then, in summary, we expect a small increase in cost for salaries and benefits. I guess is the way that is mentioned on the quarterly report, but not yet in the other expenses, nor the ones related to the expansion, nor the ones related to technology. That part should be around mid-teens for the whole year. Until
Okay.
27, in total, will be very close to 10%. But as you have access to our split data, at least in 4 or 5 lines, you will see that salaries, that is the larger number, will be below 10%, but the other 3 will not be below 10%.
Perfect. Now, this is super helpful, Enrique. Just a last question. In terms of the strong peso, it's already below 17.5. So, just wondering if there's like a sensitivity for a peso appreciation. What does that imply for your dollar portfolio? And also, if you're seeing like it could eventually have an impact in exporters.
Not really. It doesn't have really a big impact. We have around 16 billion pesos denominated in dollars. That will be the amount that we have in deposits. Then when we do the evaluation every month, it will be show us less deposits. In terms of loans, is half of that. Then is less than is around 5% of the loan book is denominated in dollars. Then it doesn't have a big impact, and that's the level we have on direct exporters. As you remember, we have been doing this analysis about exporters and impacts on the USMCA treaty, and it's very small, the number of exporters that are our customers. Mainly we have some indirect impacts in terms of providers of exporters, but we haven't seen any large customer that is only dependent on exportations.
Perfect. No, thank you very much, Enrique.
Our next question comes from Brian Flores from Citi.
Hi, team. Good afternoon. Thank you for the opportunity. I have 2 questions. The first one is on Hey Banco. I think the unit economics are showing continuous improvement, very good traction, I would say, across individuals and businesses. And as you mentioned, it is now an independent operation. So just wanted to ask, how do you see Hey Banco in 3 to 5 years? I think at some point it was mentioned a possibility was an IPO. I know maybe for now it is not the base case, but I think in terms of the strategy, it would be great to hear from you. How are you thinking about this asset? And then related to this, wanted to ask you if the spin-off brings the focus from management entirely back to Banregio, or are we going to see some still split focus or attention in the 2 entities?
Thank you for your question. Well, the focus remains on regionals, right? So obviously the technology we've been developing here in Hey has already produced great results in Banregio already. So we've been very happy with this evolution, and in that sense, I guess the whole group continues evolving in that manner. In terms of a capital raise from Hey Banco individually, I think it will remain a question about ROEs, right? So we will see a better capital cost if we have an ROE above Banregio. So in that sense, we want to continue evolving Hey Banco to have more credits, because we'll still have a superávit on deposits, and we've been having it for many years. So in that sense, we still continue growing, and that's the main focus, as you can see in our guidance, and that's will continue to bring on more profitability. And in that sense, we want to maintain a continued growth on income from fees, which will, I think, be happening in the next 12 to 24 months. So it takes a little bit more time, but definitely something that will continue to drive profitability going forward. And I think I mean, Hey Bancos in that sense is a complement to Banregio, because as I said, Banregio doesn't want to be like BBVA that has 2,000 branches, right? So Banregio will continue growing branches, I think up to 350 at the most, right? So in that sense, Hey Banco has the reach to go to all the other segments, right? So and the segments are more prone to productivity, more prone to understanding financial products better because they understand technology better. And in that sense, Hey Banco's strategy and offering will have a greater impact. Banregio as a brand is not working in that sense. It's not something that it will work for everyone, right? So in that sense, Hey Banco complements it very well as a brand portfolio in that manner, right? So we are the ones that are the best in class in Mexico in terms of the amount of products we have that digitally offer. So no one has, no Nubank or Revolut, even though it's only started. We are the entity that has the most digital products out there, both for individuals and for sole proprietors and businesses. So we have the full spectrum. We have all the services, we have payments, we have everything going on. So in that sense, what we have right now is the opportunity to focus on growth. And that will drive profitability and efficiency and being able to really have the best-in-class productivity entity as a regional out there. So I think it's amazing what we have been able to achieve, and we're very happy with the results. And profitability is being a pretty good effort on our side. And I think, as you might know already, that's what we thrive on. And there's all other players with other plays, which is fine. But our is a story of consistency, right? So in that sense, we're very happy with the results and how things are evolving, and we're open for any opportunities that might arise on that matter, right?
Oh, great. And if I may, just two quick follow-ups on sensitivity. You mentioned, I think on Eric's question, you're not considering the impact of higher interchange fees. I don't know if you have run any sensitivities in terms of if the law passes as it is suggested, if you have any sensitivity as to how much it could impact earnings. And then also, if you could remind us of your NIM sensitivity. I think it was around 13 bips per 100 bips in TIE, right? I just wanted to confirm if this has changed or you have adjusted slightly the sensitivity.
For the second question, our sensitivity for the whole loan book is around 13 basis points. Well, for the whole asset book. For the loans, is around 15, as you mentioned. But the total NIM is around 13 per 100. And as I mentioned, it takes a full year to absorb the change. Or to reflect it in the full NIM, yearly NIM. If you do the calculation of quarterly or monthly, it will be reflected faster. In terms of the sensitivity about the interchange rate, we have done some scenarios where, but obviously it's reduced the income in terms of the one that we present as transactional, but we it's not material for Regional. That's as much as we can say, because it will be a speculation in terms of because we see an upside in the acquiring business if we interpret correctly the proposal, but then we prefer to wait and see the final proposal for both sides. It has an impact, negative impact, a reduction of fees in the issuing business, but it has a potential benefit in the acquiring business. Not totally offsets one to the other, but it could partially offset the impact.
No, it was very clear. Thank you, Enrique and Ale.
Thank you to you.
Our next question comes from Pablo Ordóñez from GBM.
Hi, good morning, Manuel, Enrique, and Alejandro. Congratulations on your results and on the spin-off for Hey Banco. My question is also on the non-interest income lines. Can you help us with the outlook or guidance on what are you expecting in terms of growth of this year? The commission fees has down 13% in 2025, driven by cards and merchant fees. So what growth was the next way for these income lines, commissions, insurance, and fixed fee? And thinking on the quarter, there was a 238 million peso other income line. What is driving this income? Can you give us some color on this?
Yes, I will start with the second one that is very direct. Is the last quarter we explained that we did some provisions based on our risk methodology that we were using at that moment for both mark-to-market on the derivatives that we sell to the customers, not the ones that we have. And the other big part that it was the largest provision that we did, it was related to the increase of the securities investment that it was we were increasing the portfolio to offset the impact of the rate. Say that as it was a very high number for us, we did some advisory. We paid that advisory to understand if there was a better way to calculate this risk. And the result is that we freed up or reduced the provision, mainly on the investment securities. And the mark-to-market of the derivatives, we didn't change the methodology, but is very sensible to the peso dollar and to the expectations. We use vectors that we buy from public entities, mainly the Bolsa, in the Vala and Bolsa companies. That's the main. And there is a third line that we usually in December, we validate the level of provisions of other items, and some years we increase the provision, and it's not related to credit risk provision, it's more to the operational risk. And this was a very good year for us in terms of fraud prevention, then we free some provisions over there. For the next year, we expect a full year, very similar, but will be a full year. doesn't consider a specific quarter, because you will see that third quarter was very negative and fourth quarter was very positive. No, we expect a very similar full year, and we will continue monitoring the methodologies that our risk department uses to do that provision.
Thank you, Enrique. And for the guidance for the growth rates of other non-interest revenue lines?
We usually don't guide. It will be around 10%, what we expect growth, mainly driven by the acquiring business and the insurance business. As you can see, the market-related ones, that is mainly foreign exchange business, was reduced, both for the reduction on the spread in the foreign exchange business, as well as all the new controls that we put in the second half of the year to align to the USA regulation, not only to comply with the Mexican one, but also we are fully compliant with the USA regulation.
Thank you, Enrique. And one last question. Correct me if I'm wrong, but I recall that you mentioned in the past that all the payment business is going to be migrated to Hey Banco. Is that still the case? And which lines would be affected by this?
Part of the merchant business or the acquiring business will be migrated to Hey Banco. The business, we call it Hey Pago, and but will be seen in the books of Hey Banco, the income. Yes.
Perfect. Thank you very much, Enrique.
Our next question comes from Lindsay Shema from Goldman Sachs.
Hi, good morning, and thank you for taking my question. Maybe taking a step back, can you give a quick overview of where you see upside and downside risk? In another way, what will it take for you to get to that 10% net income growth versus the 5%? Thank you.
Well, I guess it will depend on loan growth for sure, because that's our main driver. And wholesale lending, which is as you've seen, the increase has been sluggish. In that sense, things I think might because in that sense, the cost of funds, I mean, we have ample liquidity, we have ample capital. We have very good results in cross-selling. Fees are growing at a very good rate. So I think the last thing of the possible would be loan growth. So I think that's and in loan growth, we have great results right now in auto loans, mortgages. NPL ratios have been in great control. So in that matter, I just pinpoint the fact that wholesale, as you know, has been sluggish. And in that sense, will depend much more on macro and the trade policies that we already experienced. So I think that next year, the renegotiation of the treaty will definitely have a better understanding on where we're at and how things are gonna continue to evolve. And the other thing is that we are relatively small compared to the other players. We've already taken advantage for sure of taking more market share, and that's where we continue to evolve. And I mean, we have that in our favor. That's why we're growing at a much faster pace than our competitors. But obviously there's the headwinds, as I said before.
Yeah.
I don't know.
Yeah, that answers my question. Thank you.
Thank you.
Our next question comes from Neha Agarwala from HSBC.
Hi. Thank you so much for taking my question, and congratulations on the results. Just a quick follow-up on Hey Banco. After the spin-off, should we expect any change in strategy? Should we expect more aggressive growth with Hey Banco? In the past, you've mentioned that you concentrate more on the relatively higher income segments and not necessarily go after the same customers that a new bank would go after. Does that still remain the case, or would you be a bit more open to going after Class C, Class D customers? Thank you so much.
No. The short answer is no. We are not changing the strategy in terms of growth aggressively, at least not at the beginning. Right now, our full technical and operative team is focused on the migration that will happen next weekend, starting February 1st or February the 3rd. That is the first business day in Mexico on February. But in terms of a strategy for the full year, we will continue growing small business lending. That's the main line of growth and the main focus right now. And we will be focused improving all the credit and credit scoring, and not only the credit scoring, the automating the whole lending or loan origination. On the deposit side, on the individual side, we will continue growing credit card, but not aggressively. Faster than this year, but not aggressively. And the same for auto lending. And in terms of market positioning, is the same. We have been mentioning that we want to focus on customers that are already bancarized. We are not competing in terms of we don't know what is the market for Nubank, but I guess what you mean is for non-bancarized or for inclusion. No, that won't be the case, at least not for this year for Hey Banco. We believe there is still this week we saw that BBVA launch a new promotion for their 34 million customers they say they have. And we believe they have the 34 million customers. We will be very happy to take 1 million out of that. No, it's enough, a lot of customers. And if you add up all the millions that Santander, Banamex, and Banorte have, and HSBC and Scotiabank, that's our main aim, to gain market share on the already bancarized customers, mainly because we want to do cross-selling and we want to become the main bank. As Manuel mentioned, we're very happy with all that we have built, and we have all the financial products already working in Hey Banco. Then that's our main market, is not really to go for inclusion or new customers to the banking sector.
Well, very, very clear, Enrique. Thank you so much for that. If I could just quickly ask about competition, and I'm not just referring to Hey Banco here, but the general environment that you're seeing for the banking system, both on the lending side and on the deposit side. Are you seeing more competition, and especially on the deposits with you giving higher yields with Hey Banco? A lot of the other digital players are giving higher yields. Do you see that chipping away any of your deposit base for regional, for the core bank? It would probably be less impactful for you than for the universal banks. But do you see any impact, any movements in the system, in the dynamics for both loans and deposits? Thank you.
No, for sure, that's not the case.
Okay.
No. And I mean, all the digital players gave a great yield, but only up to 25,000 pesos, right? So those very small accounts are not of an interest to us as much, because the cross-selling ratio there is like very low and very improbable compared to other regions like Brazil, for example. So in that sense, no, we're not seeing any pressure. I mean, the cost of funds has been in a very good rate at this moment. It's been not any pressures, and we see no risks going on forward. We have a lot of deposits. We have a lot of liquidity.
Yeah.
So, yeah.
Okay. Very clear, Manuel. Thank you so much for that.
Thank you very much, Ina.
Our next question comes from Yuri Fernandez from JP Morgan.
Thank you. Hi, Manuel. Hi, Enrique, Alejandro. Actually, on this point on deposits that Neha asked, I have a follow-up. Maybe your guidance is looking a little bit conservative for core deposits, right? It's 5 to 10, that is similar to the loan growth. But when we look this year, 2025, you grew your deposits way more than loans, right? So you keep bringing activity, clients. I understand the challenge on lending, given uncertainties in Mexico, but couldn't you see deposits growing more and your LDR continue to drop, and maybe not a funding increase, but a funding reduction for you, and maybe a tailwind for margins? So this is the question number one. Then I have just a follow-up on Enrique's point about the write-offs, moving to 2 years on tax deductions. I just want to confirm that the write-off period is not changing. Like, the deductions for tax purpose is changing, but the policy of write-off remains the same. I'm asking this because of the NPL ratio increase, so I just want to confirm that there is nothing changing on the term of the write-offs, and this is not impacting NPL as a result. And then I can ask a third question if there's time. Thank you.
In terms of write-off, as I mentioned, the main change that it was already published is that the deduction, the tax deduction, will only take place after 2 years of the swing, and people is correcting me here, is on the past due. Basically, is when the loans have 2 years. As I mentioned, right now, for business, we have an 18-month period to do the write-off. Then will be increased from 18 to 24. It's not really material. We will continue doing provisions. Then mainly temporarily will increase a little bit the cost of risk, but within an 18-month period will be exactly the same. And as I mentioned, for the large customers, it's not based on time or even on the legal status. Is really on terms of possibility of recovery. Then the short answer is no. We are not changing our policies, because even though we could do the write-off, the law doesn't prohibit us to do the write-off. is the time when we can do the deductibility in place. Then it's not material. And for the small loans, for consumer, hasn't changed at all. Is for around 36,000 pesos and above, where it started changing. And in terms of funding, we have two very, very different strategies in Banregio and Hey. In Hey, we have been reducing the rate. We are obviously monitoring to the large players on the digital banks, and as you can see, most of them, or all of them, have reduced the rate. And as Manuel mentioned, they have thresholds, or caps until 25, or the largest ones is 250,000 pesos, but not above. Then we will continue reducing the rate. As well in Banregio is not floated, but is related to the CETES cost. Then customers came mainly for the service to Banregio mainly. Then if it keeps growing, as long as it's an additional income, even though it could hurt the NIM, we prefer to have more customers and more liquidity at the right cost.
No, super clear, Enrique. So no change in the policy of write-offs, or no major change, and what is changed is just the deductibility, so this should not impact the NPL ratios or anything like this. And on funding, even if there is opportunities here, you are gonna be cautious, like maybe it's better to keep liquidity high and keep some deposits, right? That's the message.
Yes.
I just have a follow-up on OpEx. And for this year, I think the message is clear. You have some pressure on a little bit on the top line, and there is a carry, right, on the cost from 2025 into 2026. But looking ahead, would we see Regional or Banregio and Hey together having lower OpEx? Why I'm asking this question, like in the past 4 years, I think your OpEx was growing between low to mid-teens, right? Low teens to mid-teens. Inflation in Mexico is lower. I know you are growing to new geographies. There is a lot happening in Hey, but just checking if maybe in 2027, 2028, we could see OpEx moving to single digits. Thank you.
For 27, maybe not, but for 20, well, first, as I mentioned, the full OpEx, including personnel plus everything else, this year will be in the low tens. And for 27 and 28 should be below 10% if inflation remains where it is right now, 3.7, even 4. But I was explicit splitting personnel that should continue the reduction based on the use of technology, improvements in efficiency, but where the carry is in the investment that we are doing both in technology and in the expansion. Say that if you adopt everything as OpEx, yes, we could see in 27 or 28 one single digit increase.
Super clear, Enrique. Thank you very much, and congrats.
Thank you, Yuri.
Since there are no more questions, on behalf of our senior management, I would like to thank everyone for joining the call, and we look forward to speaking with many of you in the coming weeks. If additional questions arise, please don't hesitate to reach out to Alejandro and our investor relations team. Thank you for your interest in Regional, and have a good day.
Thank you, everyone. Thank you for your participation today.